you've said in your policy document that reining in inflation must take precedence, even if there are some short-term costs by way of a lower growth. But there are many economists who argue that after all the rate tightening that we've seen, effective policy rate going up by 3.5%, even before yesterday's rate hike, we are entering a phase where growth is not just going to moderate due to those rate actions, but is actually going to get killed. And that's the word they've used, that growth will get killed if we raise rates further. You obviously wouldn't agree with that.
No, I certainly will not agree with that, and I explained that partly a short while ago to your earlier question. Last year's action was driven by the growth inflation dynamics then, and this year those dynamics, those variables have changed. But when people make assertions such as that, there is really no counterfactual about what would have been the inflation, what would have been the growth if RBI had not acted. You must also remember that we'd hiked rates 9 times, 8 times last fiscal, and the cumulative impact of those actions is yet to play in. So I believe that inflation is going to come down on the way forward. On the growth issue, we said very clearly that we may have to sacrifice some growth in the short term, but I don't think our actions are going to kill growth as they say. In fact, I believe that they're going to support growth in the medium term.
Sure. Now, some of the actions you've taken yesterday are really a bit of a negative for banks in terms of their performance going forward. You've raised the repo rate, the savings bank rate has gone up, and the MSF, if indeed banks do avail of that facility, that again increases their cost. Have banks given you some sort of indication as to how much their net interest margins are actually likely to get compressed?
No, they had not. After all, this was a surprise to them also when we had the meeting with them. And I'm sure that it's working on their mind, and they and their managements and staff are calculating this. As you said, there was the rate action yesterday. On top of that, there were some provisioning norms. On top of that, there was an increase in the savings bank deposit rate. On the provisioning itself, we must recognize that it is somewhat offset by that 70% PCR withdrawal. So you should not see that as an additional cost. And I'm sure that I know that our banks are smart enough, are capable of factoring in these costs, and regardless of this, continue to see that credit flows to productive sectors.
Now, the marginal standing facility, what was the thinking when you actually decided to bring in the MSF? Because in the past you said that the LAF corridor, 100 basis point LAF corridor is what you're comfortable with. But with the introduction of the MSF, effectively your LAF corridor is widening to 200 basis points.
In an arithmetical sense, you're right to say that the LAF corridor is 200 basis points wide with the MSF rate at the top and the reverse repo rate at the bottom. But I believe that's not the correct interpretation. The LAF corridor, on a like-to-like comparison, which is bordered by the repo rate and the reverse repo rate, continues to be 100 basis points, which is what we've said earlier. Okay? And we've actually fixed that by pegging the reverse repo rate of fixed 100 basis points below the repo rate. Is no longer an independent variable. Coming to MSF, that must be seen as an exceptional facility, not something that banks will access without much thought. Okay? The expectation is that the rate is penal. Banks will access that facility after they have exhausted other options such as the CBLO and the market repo. We have to see how this plays out, but I believe that our expectations, the outcomes will be in line with our expectations.
Sure. Now, on the savings deposit rate, on the one hand you've floated a discussion paper in terms of deregulating the rate. On the other hand, you've gone ahead and raised it by 0.5 percentage point to 4%. Is there a bit of a contradictory message that's being sent out over here?
I wouldn't say contradictory message. The most I would concede is that it's perhaps been a bit discourteous to banks. After all, we put out a discussion paper discussing the pros and cons. We are open-minded about it. Actually, much before the discussion paper came out, we had generated a debate on this at the meeting with the editors, and this issue was discussed. And we want more debate to be generated, more stakeholders to jump in on the debate and express their view. we will take stock of that feedback and take a definitive view on the long term or the eventual deregulation of interest rate on savings deposit. But pending that, we thought that there was need and room for readjusting the rate on the deposit, which was last calibrated in 8 years ago in 2001. After all other deposit rates had gone up. Inflation is ruling high. The people who put their money in the savings bank account should get a fair deal. So we recalibrated our interest rate.
Now, on the commodity price front, you've indicated in the policy document that prices are expected to remain firm and even likely rise during the course of the year. On the one hand, while you have made that assessment, there's also the argument that a number of people make that once QE2 begins to wind down during the second half of 2011, you are actually going to see commodity prices cool. So what were the assumptions that the RBI made when you said that commodity prices will likely even rise?
There are a number of variables which affect the crude oil price apart from liquidity as a result of accommodative monetary stance of advanced economies. There is, for example, demand pressures coming from emerging economies. There is the political factors in the Middle East and North Africa which have impact on the supply side. There is the Japan factor that Japan might indent on more oil to compensate for the temporary reduction in nuclear energy. So there are a number of variables which will act on the international crude price. On the specific impact of QE2 itself, it's not certain when QE2 might end, but there is enough indication that even if it comes to an end at the end of June, as expected, as at the end of the current program period, the liquidity itself will not come down, because if I heard Chairman Bernanke, what he said was that they were going to reinvest the maturing mortgages, so liquidity will remain. Having said that, I think interest rates in the global system are a function not just of this, but also of the fiscal adjustment. A number of variables are there on the interest rate, and we will see some volatility in the oil prices. So all these factors went into our calculation of how the oil prices might move. Let me tell you that we don't have a precise model. There are lots of uncertainties, known unknowns on the oil front.
Okay, now on the regulatory side, you've instructed banks to cut their investments in liquid debt schemes to 10% of their net worth within the next 6 months. Could you give us a sense of why this was done, firstly, by the RBI, and also how much banks essentially need to pull out of these schemes in order to comply with this instruction?
See, the rationale for this was the following, that there is circularity of movement of funds, that banks were investing large amounts in liquid mutual funds, and liquid mutual funds in turn were reinvesting that money in banks. In as much as banks invest large amounts, their withdrawal is going to be sudden and simultaneous. So there could be stability concerns there. On the other hand, if liquid funds lock up their money in banks, their ability to, their liquidity could be under stress. In order to restrict this, we have imposed that regulation yesterday. In terms of what impact it might have, I checked for some numbers shortly after the press conference yesterday. I believe the net worth of the banks is about 484,000 crore. So if it's 10%, that works out to about 48 or 50,000 crore. The investment of banks in liquid MFs is about 85,000 crore, 84,000 crore. So the difference between that, about 46,000 crore, would be the 36,000 crore to 40,000 crore would be the adjustment that has to be made. And I believe we're given 6 months for that.
All right, we'll take a very quick break, but do come back. We are in conversation with the Governor of the Reserve Bank of India.
Banks must offer higher deposit rates to depositors and reduce the borrowing costs for borrowers so that they become more efficient. not that they reduce their profit margin, but they reduce their operating costs and deliver low cost credit. Should we decide to allow corporates to come in, which is something that I cannot comment on at this point of time, our ability to regulate them will certainly be a criteria in deciding on that.